Selling cash-secured puts on stocks an investor is happy to take ownership of is a great way to generate some extra income. A cash-secured put involves writing an at-the-money or out-of-the-money put option and simultaneously setting aside enough cash to buy the stock. The goal is to either have the put expire worthless and keep the premium, or to be assigned and acquire the stock below the current price. It's important that anyone selling puts understands that they may be assigned 100 shares at the strike price. Why trade cash-secured puts? Selling cash-secured puts is a bullish trade but slightly less bullish than outright stock ownership. If the investor was strongly bullish, they would prefer to look at strategies like a long call, a bull call spread, or a poor man's covered call. Investors would sell a put on a stock they think will stay flat, rise slightly, or at worst not drop too much. Cash-secured put sellers set aside enough capital to purchase the shares and are happy to take ownership of the stock if called upon to do so by the put buyer. Naked put sellers, on the other hand, have no intention of taking ownership of the stock and are purely looking to generate premium from option selling strategies. The more bullish the cash-secure put investor is, the closer they should sell the put to the current stock price. This will generate the most amount of premium and also increase the chances of the put being assigned. Selling deep out of the money puts generates the smallest amount of premium and is less likely to see the put assigned. WFC cash secure put example. Earlier today, with WFC trading at $51.33, the April put option with a strike price of $50 was trading around $1.56. Traders selling this put would receive $156 in option premium. In return for receiving this premium, they have an obligation to buy 100 shares of WFC for $50. By April 14, if WFC is trading for $40 or $30 or even $10, the put seller still has to buy 100 shares at $50. But, if WFC is trading above $50, the put option expires worthless, and the trader keeps the $156 option premium. The net capital at risk is equal to the strike price of $50, less the 1.56 in option premium. So, if assigned, the net cost basis will be $48.44. That's not bad for a stock currently trading at $51.33. That's a 5.63% discount from the price it was trading earlier today. If WFC stays above $50, the return on capital is $156/$4,844 equals 5.63% in 27 days, which works out to 43.54% annualized. Either the put seller achieves an 43.54% annualized return or gets to buy a blue chip stock for a 5.63% discount. You can find other ideas like this using the naked put screener. Below you can see some parameters that you might consider for running this screener. Feel free to tweak them as you see fit. Company details. The technical opinion rating is a 24% buy with the weakest short-term outlook on maintaining the current direction. Of 13 analysts covering WFC, 10 have a strong buy rating, 1 has a moderate buy rating and 2 have a hold rating. Wells Fargo and Company is a diversified, community-based financial services company with $1.9 trillion in assets. Wells Fargo's vision is to satisfy our customers' financial needs and help them succeed financially. Headquartered in San Francisco, Wells Fargo provides banking, insurance, investments, mortgage, and consumer and commercial finance through more than 8,400 locations, 13,000 ATMs, the Internet, wellsfargo.com, and mobile banking, and has offices in 42 countries and territories to support customers who conduct business in the global economy. With approximately 268,000 team members, Wells Fargo serves 1 in 3 households in the United States. Summary. While this type of strategy requires a lot of capital, it is a great way to generate an income from stocks you want to own. If you end up being assigned, you can sit back and collect the nice 2% dividend on offer from WFC. You can do this on other stocks as well, but remember to start small until you understand a bit more about how this all works. Risk-averse traders might consider buying an out-of-the-money put to protect the downside. If you have any questions, feel free to reach out to me by email or on Twitter. Please remember that options are risky, and investors can lose 100% of their investment.